everyone, so today we'll be doing topical MCQs of accounting concepts. Pay close attention to the key concepts. Some questions test similar ideas but in different ways. Ready? Let's start. Question 1. Which item incorrectly applies the matching concept? Correct answer, A. Explanation. Option A talks about capitalizing staff expertise and writing it off over time. But here's the problem, staff expertise isn't a tangible asset you can capitalize. The matching concept is about aligning expenses with the revenue they help generate, like depreciation or wages. Since you can't quantify or amortize expertise, this option misapplies the concept. That's why A is wrong, and the question asks for the incorrect application. Question 2. An item is included because it affects how financial statements are interpreted. Which concept is this? Correct answer, B. Materiality. Explanation. Materiality means including items that could influence decisions. If leaving something out would mislead investors or creditors, it's material. For example, a small error in a large company might not matter, but the same error in a small business could be significant. Here, the question describes materiality perfectly. Question 3. Goods were dispatched on the 31st of December but invoiced on the 3rd of January. When should the sale be recorded? Correct answer, D. Realization. Explanation. Revenue is recognized when the goods are transferred, not when payment is made or invoiced. Since the goods were dispatched on the 31st of December, the sale happened then. The invoice date doesn't matter, realization is about when ownership transfers. That's why D is correct. Question 4. A business excludes old inventory from valuation because it might be obsolete. Which principle is this? Correct answer, C. Prudence. Explanation. Prudence means being cautious, don't overstate assets or profits. If inventory might be obsolete, valuing it lower avoids exaggerating financial health. This is classic prudence, anticipate losses but not gains until they're certain. Question 5. What does material mean in financial statements? Correct answer, D. Affects users' economic decisions. Explanation. Materiality isn't about size alone, it's about impact. A small error could be material if it changes how someone interprets the statements. Option D captures this. If an item could sway decisions, it's material. Question 6. Which concepts apply when charging annual depreciation? Correct answer, A. 1, 2, and 3, consistency, matching, accruals, prudence. Explanation. Depreciation spreads an asset's cost over its useful life, matching. You must use the same method yearly, consistency. And writing down the asset avoids overstating its value, prudence. Realization, 4, doesn't apply here, it's about revenue, not expenses. Question 7. Inventories are valued at the lower of cost or net realizable value. Which concept is this? Correct answer, D. Prudence. Explanation. Again, prudence. If inventory's market value drops below cost, you report the lower amount to avoid overstating assets. This is a direct application of, anticipate no profits, but all losses. Single quote quote. Question 8. Which concepts are not reasons for including depreciation? Correct answer, D. 4 only, realization. Explanation. The question asks for concepts that don't explain depreciation. Realization is about revenue, so it's irrelevant here. Materiality, 2, and prudence, 3, can apply. For example, prudence ensures assets aren't overstated, but the question wants the exclusion, so D is correct. Question 9. Revenue is recognized only after it's earned. Which concept is this? Correct answer, D. Realization. Explanation. Realization means you record revenue when it's earned, not when cash arrives. For example, if you deliver goods today but get paid next month, you still recognize revenue today. That's realization in action. Question 10. Mia sent goods on sale or return, but the customer hasn't confirmed. How should she account for them? Correct answer, C. Realization. Explanation. This is tricky. The key is that ownership hasn't transferred yet. Realization says revenue is only recognized when the sale is certain, so until the customer accepts the goods, Mia shouldn't record the sale. Prudence, B, might seem tempting, but the core issue is timing of revenue recognition, which falls under realization. Question 11. Which item is capital expenditure? Correct answer, A. Cost of a printer for an existing computer system. Explanation. Capital expenditure is for long-term assets. A printer upgrades the system's value, unlike repairs or rent, which are revenue expenses. Even though it's small, it's still a capital addition. Question 12. Which items go in the general journal? Correct answer, B. 1 and 3 only, goods taken by owner and non-current asset purchased on credit. Explanation. The general journal records non-routine transactions. Owner's drawings, 1, and credit purchases of assets, 3, don't happen daily. Routine purchases like stationery, 4, go in the purchases journal, not the general journal. Question 13. Why distinguish capital and revenue expenditure? Correct answer, D. 3 only, to get a more accurate profit figure. Explanation. Capital expenses, like buying equipment, are spread over years. Revenue expenses, like repairs, hit profit immediately. Mixing them up distorts profit. That's why we separate them, to show true performance. Question 14. Goods on sale or return weren't recorded in sales. Which concept was applied? Correct answer, D. Realization. Explanation. No sale was recorded because ownership hadn't transferred. Realization delays revenue recognition until the sale is confirmed. This matches question 10's logic. Question 15. Inventory is valued at the lower of cost or net realizable value. Which concept is this? Correct answer, D. Prudence. Explanation. Third time's the charm. Prudence again, always err on the side of caution to avoid overstating assets. Question 16. Why can't the workforce's skill be recorded in financial statements? Correct answer, C. Money measurement. Explanation. The money measurement concept says only quantifiable items can be recorded. Skills aren't measurable in monetary terms, so they're excluded, no matter how valuable they are.